Hey everybody, this is Eric Jans. We're going to do things a little bit differently today. We're going to be on camera, and I'll introduce everybody that's here. Kevin Riley is here with Nationwide. Excuse me, I'm sorry. David Smitherman's here with Nationwide. We talked to Kevin yesterday. David's a regional vice president, and he's been with them since 2019. And we also have Rachel and Misty back again from yesterday. They're with Concourse. Rachel Smith is Vice President of Account Management, and Misty is the Director of Internal Sales at Concourse Financial. And so they'll be here for jump in with questions. Today, David's going to talk to us. Before we get started, let me talk about a few little things here. Long-Term Care Awareness Week. Can you see the big screen here? Let's see. Sorry about that. I'm learning this system, guys. Here we go. Long-term care awareness week. Make sure to log in to our new content online to see the word of the day. And at the end of the week, we're going to have, if you submit all 5 of the words of the day, we're going to put you in the in for a prize. And also make sure to register for the webinars every day this week. Each one has its own link, so make sure you register for those as well. Today we're going to talk about the solution. Yesterday we talked about the problem. Today we're going to talk about the solution. So there are 5 different types of coverage when it comes to long-term care. And today Dave is going to talk about the second 2, I think. We've got our traditional. We've got your 2 different kinds of hybrid, one with life insurance, one with annuities. We've got short-term care. We'll talk more about that tomorrow. And then we've got your prepaid home health care hours that we use through True Freedom. So those are the 5 types of products that we're talking about this week. I'm going to turn it over now to David. And let me share your screen here. Okay. Sorry, guys. Here we go.
Awesome. I am sharing it now. Can you guys see? Can you see that, Eric? See the page I'm showing? Consider the options for long-term care.
Yeah.
Awesome. Awesome. Well, thanks everybody. Appreciate you tuning in with us this afternoon. Thank you for the opportunity, Eric, Rachel, Misty at Concourse. Before we get started, I just would like to give a plug for Concourse. You know, they're the best in the business when it comes to this in the brokerage arena. The long-term care team they have is second to none, and they know all these products inside and out, so they've got you covered. I'm a big believer and proponent that any plan or any care solution is better than no plan. So any of these options that we're going to talk about today will certainly have a large impact for your clients and their family members down the road. So what I thought we'd do, kind of building off of Kevin's talk yesterday, is go through kind of high-level overview of the different types of solutions, as Eric set up on that original slide, that are available in the marketplace today. So we're not going to talk specific products. I think that's coming later in the week, maybe on Thursday in this series, but just the types of different solutions that are out there, and then kind of where they fit, who they might fit better for, and some talking points that to help have more meaningful, more successful conversations with clients, and kind of help you navigate which product may be best suited for different types of clients. And of course, Misty and Rachel and the team at Concourse can help you with that as well. I'm going to zoom in on this, try to make it a little bigger for everybody to see. So when you look at kind of the true long-term care landscape, there's really 3 distinct product types that are out there. And we'll kind of go through these one by one. The first one is, and the one that's been around the longest, is what we call a traditional or standalone long-term care. This first came out, I think, in the 80s. It was the biggest form of long-term care. There were dozens of carriers that were offering it into the 90s and early 2000s. And then that product type kind of went through a transition period and is pretty well stabilized since then. But general characteristics of a traditional standalone long-term care policy is generally when you set up these policies, any of these types of policies are going to provide some sort of daily or monthly long-term care benefit to the consumer. That when they go on claim, they're entitled to X amount a day or X amount per month of benefit. These products really were these original traditional standalone policies. They only provide benefits for long-term care. And you'll see how this differs with the next two categories as we kind of move left to right on the screen. Generally speaking, at least the products that are available nowadays in the traditional standalone product space require kind of a pay-as-you-go lifetime premium. You just pay it indefinitely. A good way to think about it is they're kind of like our auto insurance or our homeowners insurance. It might be a good analogy that somebody can understand. You pay a monthly or a quarterly or an annual premium for your coverage, and then it's really use it or lose it. And I don't mean that as a negative. If you don't ever have an extended healthcare event that would require long-term care to in a claim situation, you don't get anything back, right? There are no other benefits outside of the policy, and that's really what this bullet point highlighting the fact that it only provides long-term care benefits. There's no death benefit, there's no surrender value, cash value, liquidity, etc. So much in the same way, if our house doesn't burn down, we don't get anything back from our homeowners premiums. We don't want our house to burn down. That's not a negative. That means everything has gone fairly well if we haven't had to file a claim for our homeowners or our auto insurance or our long-term care insurance. One of the things that is readily available in the traditional standalone long-term care product arena is many different inflation options. And that's really important because when we're pricing out the cost of care and what we might need down the road to make sure that we have benefits that can fund that type of care. If we're looking at cost of care today, and let's say we're 55 or 60 years old, today's costs are somewhat irrelevant. They help us establish a baseline, but most people aren't going on claim or aren't going into an extended healthcare event until their 80s. So really, we want to be planning for, with inflation, especially in the medical field, as steep as it's been over the years. We want to make sure that whatever benefit we buy, oftentimes, if we're young enough, we want to make sure it's kind of keeping pace with inflation. So inflation options are very common on these types of products. The premiums may be tax deductible if in a business setting. So if your client is a business owner, oftentimes they'll ask when we're doing insurance planning if they can fund the policies with business dollars rather than their personal dollars, personal checkbook. Usually there's some sort of tax advantage, tax deductibility for doing so. So that's usually a fairly attractive opportunity. And nowadays, most if not all, of the traditional standalone long-term care policies that are available are on a reimbursement payout chassis. I'm not sure if we got into it yesterday. I was not on the call. There's kind of two different types of LTC coverage. There's reimbursement policies, which are probably the most common, been around the longest. And now also there's cash indemnity policies. And the difference is with your reimbursement policy, the policy will reimburse you for your actual qualified licensed care expenses that you received, whether that's in the home, in an assisted living facility, nursing home, adult daycare, et cetera. So if you had a $8,000 a month benefit that you were eligible for, but your expenses for that month were only $6,000, the company will reimburse you for the $6,000 of actual expenses incurred. You don't forfeit the remaining $2,000 you didn't use. Those are going to stay in your pool of money for later use. On the flip side, cash indemnity policies, if you had an $8,000 a month benefit, when you go on claim and the claim's certified, the insurance company just sends you $8,000 and you spend it how you see fit. So if it's more than you need, in that example, you'd have $2,000 additional in excess that you could put in the savings account for later use should you need it. So that big difference kind of on the benefit payout types. Most of the traditional policies that are still around are really only offering that reimbursement style benefit these days. So when a client's looking at these types of coverage, here are kind of the highlights, kind of client decision points, pros of the policy. It's usually the most customizable type of policy. There are more ways to customize these quotes and to build out a plan that really fits the need. Benefit duration, you can go shorter, longer, inflation options. There's maybe some return of premium options out there in the marketplace. So there's a lot of different ways you can customize these policies to find a good fit. Again, inflation, they're usually always going to offer an inflation option these days. This is typically going to be the least costly option, least out-of-pocket cost for that. It is use it or lose it, as we discussed. If we don't ever, if all things go well, and we don't ever have an extended healthcare event, which is how I hope to go, then we didn't derive any benefit, financially out of this policy. We certainly had peace of mind that if something were to happen as we go into and age through retirement, that we are covered. But there's no physical benefit back to us if we do not. And then lastly, premiums on this type of policy are not guaranteed. They can go up in the future. We've seen that happen over the years. I think the pricing of these is probably stabilized a lot compared to the original iterations of the policy, but we have seen enforced premium increases on a lot of these policies from basically every single carrier that's ever offered this type of coverage. That has not been just a one or two company problem. It's been kind of widespread from any carrier who originally priced these products. And the reason was, when they first came out, we didn't really have claims data and actuarial as well-defined actuarial data to price the products, so they were somewhat underpriced originally. So that's the traditional kind of. A lot of times, if you talk about long-term care insurance, if somebody has been approached about it in the past, especially if it was 5 or more years ago, 5 to 10 years ago or beyond, this is probably what they're thinking, if they're aware of the product set at all. A lot of people own this type of coverage. It's very good coverage. Very rarely would I ever recommend replacing it. Usually people will come and say, hey, here's what I've got. It's a policy like this. Can I do better? Usually the answer is no. Usually those benefits, even if they have had a rate increase, are pretty good, pretty healthy benefits based on the price that they are paying. So as we transition to the middle column now, this is kind of the second type of policy that's very common these days. And this is where we have a permanent life insurance policy, not term insurance that lasts for 10 or 20 years. This is permanent life insurance. And we can attach an optional long-term care rider to these policies, okay? Pretty much every major life insurance carrier out there these days has a feature like this that can be attached to either some or all of their permanent life insurance products in the portfolio. Now, you pay a little bit more for that. You pay for the rider, so you don't have to have the rider on a life policy, obviously, but if you do, you'll pay a little bit more for it, and there's a little additional underwriting for it. We're underwriting the life insurance part for mortality, and then we're going to underwrite the long-term care part for morbidity, which is, think about things that would, be disabling, crippling, that sort of thing. So this is very, very common. One of the nice attributes of this type of plan is oftentimes these are written on guaranteed premium type contracts. So there are some non-guaranteed life insurance policies, some different universal life, index universal life policies out there, but many of those we put guaranteed no lapse provisions, no lapse riders on. So premiums on that would be guaranteed as well. And essentially what you're doing is you're paying a little bit more money. The rider is not very expensive compared to the overall premium for the life insurance policy. But what it's allowing us to accelerate our death benefit while we're still living. Excuse me. So it's turning our death benefit into living benefits that we can use to help pay for our care. So should we need long-term care, should we need extended care, then we're basically just accelerating a portion or all up to all of the death benefit to pay for our long-term care, and those benefits come out of that policy income tax free, just like the death benefit pays out. The life insurance death benefits are all income tax free. So that is a really nice solution. Any benefits that are paid out for long-term care just reduce the remaining death benefit dollar for dollar. So any unused death benefit, basically anything that wasn't accelerated for long-term care, and there's a monthly, just like on the traditional side, there's a monthly benefit that gets established when we design the policies. It'll say that, you know, you could pull out, use that same example, $8,000 a month. And that's just going to, every time you do that, it's going to reduce your remaining death benefit dollar for dollar. So each month, that's your death benefit's going to drop by $8,000 if that's what you're pulling out of the policy. And then anything that's left in the death benefit when you pass away is going to pay out to your beneficiaries as a tax-free death benefit. So that's kind of a cool product where it turns it into, it's not use it or lose it, like the traditional standalone options we discussed first. And you have guaranteed premiums typically, again, when you use the types of products that do have the premium guarantees in them. One thing that's kind of cool about this product category that's a little different from this next one we'll get to is you got and the first one really, you've got very flexible premium patterns, premium schedules. So we find some people who just kind of want to do a pay as you go, pay it indefinitely, just like they would on the traditional policy. We're going to pay it as long as we're alive, or unless we surrender the coverage. You can set it up monthly, quarterly, annually, however you want. Then we also have a lot of people who say, I want to pay this. Can we shorten the premium payments down? I'm willing to pay a little bit more each year so that I don't have to pay this for the rest of my life. So we see a lot of people who set it up with like a 20-year payment structure or a 10-year payment structure, or hey, I'm 50 years old. I really want this to be paid off by the time I'm retired. So we might want to have it paid up at age 65 or 67 or 70. So you really have ultimate premium flexibility on how you design this type of product. And we can even do single premiums, which we see a good bit of. With this type of product, we do see cash indemnity or reimbursement plans available. Rachel and Missy's team can work with you on this, and just be sure when you're comparing things, they're not always apples to apples. So if you're looking at one, be sure you know which type of benefit it's paying out as reimbursement or indemnity. Typically, the indemnity contracts will be a hair bit more expensive because you're getting that extra flexibility and value that comes with, well, I'm going to get my full monthly benefit at claim time. I'm not going to be limited or capped at what my actual expenses were. And that includes informal care. So my spouse or my daughter could be my caregiver. And if they're not a licensed, if they don't work for a licensed healthcare agency, that still qualifies for a claim and payment on the cash indemnity plan. That would not be a reimbursable expense on a reimbursement plan. So there's little nuances to be aware of and reasons that an indemnity solution oftentimes might be a tad bit more outlay premium wise. Lots of different types of permanent policies. We won't get into that today, but there's, again, we tend to focus on the guaranteed type products when we're looking at these options. So back down to client decision points, not use it or lose it. Premiums are typically guaranteed. You're getting the full benefit amount paid one way or the other. It's either going to pay out as a full death benefit or as a full long-term care benefit or some combination of both. So if you had a $500,000 death benefit, let's say, and 250,000 of it was paid out as long-term care payments over a series of years, and then you passed away, the remaining 250,000 is going to pay out to the beneficiaries, the client's family, their beneficiaries. So you're getting a reasonable rate of return on that, and a kind of a guaranteed rate of return if you think about the death benefit being there to pay out at some point down the road. We don't know if we're going to have a care event. We know we're going to have a death. I'm not trying to be morbid, but that's one of those, there's no outrunning that one. Again, extraordinary flexibility from a premium funding standpoint. And now this one's going to tend to offer, it's a little bit more limited in the long-term care design. Like we can't put an inflation rider on this type of product like we can on the traditional or this next solution we'll look at. So This product is really more, we see a lot of the younger clientele choose this product type, somebody who needs or wants death benefit first, or it's a straight combo sale. I need death benefit, but I also want some long-term care benefit down the road. Great product for that. So we typically see a lot of younger families, younger folks looking at this type of solution. People who still have that income replacement need. You know, I need to make sure first and foremost that my wife and kids are taken care of if something happens to me from a death standpoint. So I need to have life insurance in place. That's going to replace my income so they can maintain their standard of living. But as I age and as I get closer or into retirement and the kids are out of the house and my income replacement need drops and my savings increase, having that rider on my policy basically lets it kind of morph into, as I age and my life cycle dictates, it kind of morphs into the next phase of my life with me. And now it's a guaranteed long-term care solution that I have as part of my retirement portfolio. So it's really that either life insurance first with an option, you know, to have that long-term care in the future, or it's somebody who really likes the idea of both. And it's really kind of covering two birds with one stone. So that's the life insurance with a long-term care rider. The last product type we'll talk about today is what we refer to as linked benefit or asset-based long-term care policies. And these are similar to this middle column with a couple of key differences. So on this product, these products are usually life insurance based. Some of them are annuity based. So that's why we call it asset based product. You've got some underlying asset, a life insurance or annuity policy, but the death benefit or the annuity benefit are really secondary to long-term care. So this one, it sits on an annuity or a life insurance chassis, but it's really a 100%, it's a long-term care solution. The reason it's important it sits, well, I use the life insurance chassis as in my examples. The reason it's important it sits on a life insurance chassis is because it does allow us to guarantee those premiums. Most of them sit on a guaranteed life insurance chassis, so you've got guaranteed premiums, so they're not eligible for rate increases once the policy's enforced, just like the life insurance options. But that's different from the traditional policies that don't have the premium guarantees. We see a lot of short pay solutions from a premium funding standpoint on the linked benefit product. So we see a lot of single premiums, 5-year payment schedules, 10-year payment schedules, but we also see those lifetime options as well. So you do have pretty good premium flexibility, not quite as much flexibility as you have with the life insurance with the rider solutions, but plenty of options to suit anyone's need. One of the big benefits of this type of product compared to the life insurance policy with the rider is you can put inflation, and we often recommend putting inflation on these policies. So again, if we're starting at a $4,000 a month benefit today, we might put a 3 or 5% compound inflation rider on that. So every single year that pool of money and that monthly benefit are incrementally growing by 3%, and it's compounding over time. So when somebody looks out at age 80, 82, 85, they have really substantial tax-free long-term care benefits that have grown and accumulated, but they didn't have to buy that much at the beginning. So they might have some premium savings by starting smaller and letting the inflation option grow the policy over time. One cool piece about this type of product is it's most of them are simplified underwriting. And what we mean by that is most of these plans in the marketplace do not require a paramed exam where a nurse is coming to the client's home to get a blood sample and a urine sample and check their height and weight and take their blood pressure, and like they do for life insurance. That's not part. There's no labs involved on most of these, and a lot of it's done electronically and with medical records. So usually see a more streamlined and faster placement process on these types of products. And the reason is there's not nearly as much life insurance on the line from the insurance carrier standpoint. Whereas over here, we're underwriting, we got to make sure we have the underwriting in place to profitably place this business in the event of a death or a long-term care need. The linked benefit policies, we're really only worried about the long-term care risk and reserving for those payouts, because if death occurs, we're essentially refunding premium to the policyholder. So your death benefit on these linked benefit policies usually is equal to or slightly greater than the premium paid. So if I paid $100,000 into one of these policies, whether it was all up front in one single payment or I did that over 20 years, and I pass away without ever needing long-term care, I'm going to get back roughly 100,000, not I, my beneficiaries in the form of a death benefit, my wife, my kids, my family, my trust, whoever my beneficiaries are going to get back roughly 100,000, maybe a hair more, 110, $120,000 of death benefit. So it's not a big life insurance death benefit play like this middle column is, but it's at least not use it or lose it. I'm getting something back. My family's getting something back. I don't view that as just throwing my money away. Okay. You do have indemnity and reimbursement plans available in this product style as well. One cool thing, some of these products, depending on how they're structured, which carrier and product you're looking at, some of these products will allow clients to use health savings account at HSA dollars to fund part of the premium on a pre-tax basis. So they could pay their premium just as is, pay it out of pocket, and then take their statement, submit it to their HSA company for partial reimbursement with tax-free benefits. They can do that on the traditional standalone policy as well. They cannot do that on this middle column, this life insurance with the rider. Again, check with Misty's team and your individual carrier you're looking at. But that is a cool solution. You can also have the business. You also see some of the business tax deductibility in some of these products as well. So that's always nice. Again, rounded off here, client decision points. Premiums here are guaranteed. It's not use it or lose it. So these top two bullet points are basically exactly the same in the life insurance with the rider. Guaranteed premiums, not use it or lose it. Your family or you're getting some benefit back out of the policy. Your death benefit, again, is equal to or greater than the premiums paid usually. These policies also have a return of premium option. So they'll have some sort of cash value, some sort of equity in the policy, so that if you decide at some point down the road, you don't need the coverage anymore, you don't want the coverage anymore, the client can't afford to keep paying the premiums if the policy's not in a paid up status, there's often a surrender value, a liquidity that if they walked away from the policy, they get something back for it. Again, inflation options are very prolific on these types of products. And this is going to provide kind of your maximum long-term care coverage, maximum pool of money with a smaller death benefit compared to this middle section that is offering a higher death benefit that equals your long-term care coverage. This one is what I would consider kind of a 100% long-term care strategy that just so happens to sit on a small life insurance chassis, which is going to, again, creates that benefit of not being use it or lose it. Eric, Misty, any questions? Rachel, any questions on this? Do not see anything in the chat. I know I just went through that quickly, covered a lot. Anything you'd like me to hone in on in particular?
No, I think that was a lot of really good information. And as David had mentioned in the beginning, we have great partnerships with Nationwide and David, along with Kevin and One America, and we have other carriers as well. And their biggest concern is not which carrier you go with, but that you're presenting this opportunity to each and every one of your clients, because it is a need. The longer, we're living longer, and so that need is going to come up. And one of the things that we offer at Concourse is the opportunity for us to do your case design for you. So when you meet with a client and the opportunity arises, you would contact your internal over at Concourse, and we would be able to run the Nationwide policy. We'd be able to run One America, and we could find the best fit for your client, because we do have, there's not one product fits all. Everyone has different scenarios and has different situations. So that is what we're here to assist and help you with. Rachel, do you have anything to add to that?
No, I think that was a great synopsis, Misty. I think, the point we're trying to make is, Eric is your key person inside your organization, and but we're going to be helping you guys in any capacity that you need. Whether you need further training on what you're learning, this is just the first step to see if you're interested in it. We can do a deeper dive than what you're hearing this week. We have people that can help you in the field if you have a client, and we can actually help close the sale. We have people that can help you find the right product. So you don't have to feel like you're an expert. You just have to know the need, and you have to, bring it up in a way that people are interested in. In saying things like, "Hey, do you have long-term care insurance?" Probably isn't the best way to start the conversation. There's other ways to do that, and so just want to make sure you guys know that you have a lot of resources. You don't have to be afraid to get started. We think this is Blue Ocean, a great opportunity for you to expand your business with the clients you're already working with. And so this week is just the beginning. So that would be the only thing I'd want to add.
Rachel, you just spoke to, and I'll send this piece as a follow-up. We probably don't have time to go through it all today, but this is a piece about, it's just kind of 6 quick tips for how to have better conversations, long-term care related conversations with clients. And you just hit on number 6, which was kind of word choice and how we market it, how we ask questions. When we talk about long-term care insurance, a lot of times there's a negative connotation with that. Somebody might have gone through a family event. A lot of consumers instantly think nursing home. This is nursing home insurance. Whereas really, if a proper plan is in place, it allows the client and their family to keep them out of the nursing home. Nobody wants to go to a nursing home. This allows them to kind of get the care on their terms, where they want, by who they want providing it. And so you just hit the nail on the head with that, Rachel. We're talking about keeping conversation focused on solutions, not long-term care policies. Don't talk about things like, I don't personally like the kind of the guilt trip sale or the scare tactic of, well, you don't want to be a burden to your kids, or you don't want to be stuck. It doesn't come off that well. So we have this piece that kind of talks through a couple of different ways of having better conversations. One thing I will call out while we have a minute or two left, again, start to make sure people know that it doesn't just mean nursing home. Start the conversations talking about home health care. 70% of LTC claims in the marketplace now are being provided in people's homes, either informally by their family members, or with formal care, friends, family members, or formal care by home health care agencies, home health aides, and the like. So most of the care that's being administered in America today is being done so in the home. A lot of times later on down the road, if somebody progresses where it's just not feasible and they need more round the clock type care, medical treatment, access to RNs and that sort of thing on stuff. Sometimes at that point, kind of towards the end, a facility might need to get involved. Or a lot of the people that are in nursing home facilities, true nursing home facilities today, are folks who ran out of money and don't have any other options, and that's the Medicaid option. If they finally qualify for Medicaid because their asset level is so low, they've got no other place to turn. The problem with that is you lose all choice and control. There's long waiting lists, and you end up kind of going where there's a bed available after usually a year or more, kind of on a waiting list. So that's not ideal. The last thing I would say, a lot of times we find that even within a couple, I would make sure if you are talking to a couple unit, and there's a wife, involved, make sure she's involved with the conversation and helping drive that sale. Women will buy long-term care and will help steer the husband. Most men are stubborn and think it's not going to happen to us. It's a waste of money. Why are we talking about this? But women understand it. And women also typically outlive their male counterpart. Women live longer. And so oftentimes what happens is male starts going downhill sooner. His wife or his companion ends up being his caregiver, which impacts her physical, emotional, financial well-being. And then there's nobody there to return the favor, once she kind of, has an extended health care event. So what we often see, going back to this list, women will talk to you about any of these. They want to get a plan in place, and they'll find the one that, once you present them the different pros and cons and solutions, couple samples, they'll make a decision. Oftentimes men, you might want to focus on this middle column, because this is the one that'll appeal to their ego. We found it's hard to argue with them and change their mind that no, it actually will happen to you, and throwing statistics at them doesn't usually work. I say at them, at us, doesn't usually work. So if you just agree with them and say, you know what, I hope you're right. I think you're right. It probably won't happen to you. That's why we think this life insurance policy, that we can put a long-term care rider on just in case, would probably be a better fit for you. Maybe we'll look at a linked benefit policy for your spouse, but we'll use the life insurance with a long-term care policy. That way, if you're right, and I hope you are, whenever you pass away, there's a big death benefit, a lot more death benefit that's paying off to help take care of your wife or your kids or your grandkids. So sometimes don't be afraid to kind of split up. If you got inside a family unit, there might not be again, like Misty said, it's not a one size fits all solution. And even within that one home, you might have a husband buy this type of policy and a wife buy this type of policy. So it just kind of varies. But I'll send this piece as a follow up, as well as with the original document we were just looking at.
And I'll make one more statement, and this, this is something to think about as you're reviewing this piece. Is all you're doing is creating a plan. Those are the words that you need to focus on. Is we're creating a plan, just like you're working with your clients to create a plan for retirement. You're creating a plan for their health. You're creating a plan that's going to protect the lifestyle that they have created for themselves in retirement. And if you focus on those words and not the scare tactics, it's going to come across a lot better. Been doing this a while, and from my experience, working with someone and, having that discussion about protecting assets in retirement from a care event, not long-term care, but a care event, certainly will resonate a lot better with males who are looking at this thinking they'll never need it.
Yeah. Spot on.
This is really great. I'm glad you pointed out too the 70%. I was going to put that in one of the slides, that most people think of this traditionally as nursing home insurance, and now most people that need long-term care are using home health care type services. 70% of those.
Yeah. Here's another graphic on that, Eric. The 70%, and then about 18% are in assisted living. So you can do the math. It's a very small percentage of the population that's actually getting their care in a nursing home.
Right. And one thing I'll say too about Concourse. So the reason that I pulled these guys in initially, I've been using them a long time, is I love being able to go to talk to a client and not know exactly what I want to offer them. Every situation is different. So I will come back with my ideas, but I'll present them to Misty and I'll say, can you show me what would be a good option in this situation? And it may be, I might get 3 or 4 different ideas back. I don't have the one tool in the toolbox. I've got several options we can talk about. And even more now with North American Insurance, we can go all the way down to something like a True Freedom, which we'll talk about more later in this week. But there's so many options when it comes to how much you're spending per month. You could go True Freedom on the low end all the way to like a traditional long-term care or a hybrid product that's a lot more expensive, but it just depends on the person's needs. And I love that we have these different options. I don't see any
Eric, I would
questions.
also mention too, not everybody can qualify for every plan, right? Depends on the situation. And I think a lot of times when you boil it down, the scary part, as all of us on the call as an advisor, is, what do you do? What do you ask? And it kind of boils down to what type of plan do they want? Well, we'll see what you can qualify for. You've got to do your field underwriting, which you guys are really good at that already. And then how are you going to fund the plan? And what do you want the plan to do for you? that kind of helps you narrow down which plan is correct. If you can't afford the plan, it's always better to have some coverage, in my opinion, than zero. We hear that a lot. Well, that's really expensive, you know. Well, we would rather have some coverage than no coverage. And a lot of times with these companies, you have the same access to their concierge service. It doesn't matter what size policy that you buy. So keep that in the back of your mind too, that if you bought a policy that only gave you $1,000 a month of coverage versus $10,000 a month coverage, you still have access to the people in the background that are helping you find support, having, you know, giving them a phone number to talk to, because a lot of times that's what happens to people. They just don't know where to start. And so if you have an insurance plan in place, they have a phone number you can call, and they're going to help you start. And so just keep that in mind too when you start seeing, you know, how expensive some of these plans are. It's better to have some plan than no plan, and these are also tax-free benefits. We don't talk about that enough. That can be added to the retirement income that you already have. Maybe you're going to have to pull from some of your retirement to help fund this, but we have a policy to help subsidize it. So there's a lot of different ways to think about it, and when we're out there talking to our clients.
It's awesome. We don't have any questions on the board that we haven't answered, and so I will wrap this up for today. Tomorrow we're going to talk about how to cross-sell long-term care products to your current clients, whether it's Medicare or whether it's under 65. So all the different products we talked about in that first slide are available to be talked about tomorrow. We'll have some of our agents. Sharon Luker will be on tomorrow, and Renee Shannon will be on tomorrow to talk about how they offer these products to their clients, how to cross-sell, especially the Medicare stuff. So I thank you guys for being here. Again, go back and check out the website for the new content today and the secret word, and register for tomorrow's webinar. Thanks.
Thanks, everybody. Have a great day.